A lot of times people are qualifying for much more than they'd ever want to spend because they're being realistic. They're saying, I don't. So,
do you think there's a magic number in your mind for what really puts somebody in a good position of an affordability standpoint from the... Right. Is there a minimum credit score that if you were under that, you might as well?
Yeah, I mean, right now, 620 is really kind of the cutoff.
Yeah.
The FHA advertises 580, but most of the banks don't really go down to that 580. So yeah, I would say 620 is typically where you want to be.
When they're looking to determine if you're qualified year, they're looking at a month to month,
Yeah, there's
right?
three things. When you're looking at a mortgage, three things: employment and income, credit history, and then assets. Do you have money to buy the house? So with employment, they want to see you've been working full-time for 2 years. Really don't want any gaps of employment. Now, gaps of employment, I was laid off for 2 months. If that happened, especially in this past couple of years, that's more common than ever, it seems like. Sure. So as long as you can show you've been working for a 2-year period, if you were going to school, if you're going to college full-time, they can use that as employment. So they're going to look at, do you have that 2-year history? The second component is how much are you actually making. So I'm making $100,000 a year or $50,000, whatever it may be. They take your annual income divided by 12. So because what they really focus on is your gross monthly income.
Okay.
And then from there, they look at the credit. They look at how much, not so much how much you owe, how much you're required to pay each month, the minimum monthly payment. So credit cards, student loans, car loans, mortgages. So they take how much do you pay each month, how much do you make gross, and that's the thing with qualifying. They use your gross income, so before taxes. So that's why I tell, a lot of times people are qualifying for much more than they'd ever want to spend because they're being realistic. They're saying, yeah, on paper I make $10,000 a month, but after taxes I get maybe $6,000 of that.
Right.
So.
Do you think there's a magic number in your mind for what really puts somebody in a good position of an affordability standpoint from the debt to income?
There's debt. So right now, like I mentioned, you can qualify at a 50% debt to income ratio. I don't know if I'd ever suggest that because that means 50% of your gross income is going out towards the mortgage plus other debts. So in reality, you're not, that 50% is probably a 60, 65 after taxes. But you can qualify for that, and that's where I was saying that it's kind of easier in a sense to get a loan. Because old school, traditional, when I started, the suggested ratios were like 28-36.
Okay.
So they say 28% of your income should go towards the housing payment, 36% should go towards your housing payment plus other debts. And then it was going 33-38. And then, so I mean, this is all just personal preference because some people are more comfortable with a higher payment than others, but I would think no more than maybe 30% of your income going out towards a housing.
Your gross?
Gross income at most.
Okay.
Because again, it's gross, because that really translates to about 25%.
Right.
But some people are, they're a little bit, some people wouldn't think it. They say, I don't even want more than 10% of my income.
Right, sure.
How realistic it can be.
If somebody comes and says, like, this is what I make, how much can I afford?
Yeah.
How do they back into that number as opposed to going from this is what I am comfortable with? Is there a way to back into that number?
What I usually do, if somebody does, I'll say, okay, you make $5,000 a month. And I ask them, well, how much do you pay per month for cars and credit cards and whatever? And they say, I make gross $5,000 a month, and I pay $1,000 in debts. So then what I do is I say, all right, well, the maximum debt to income ratio is going to be 50%. So that means the maximum of your monthly payment is going to be $2,500. So $5,000 a month, half of that is $2,500. You pay $1,000 in car loans, credit cards. That means a maximum mortgage payment could be $1,500.
Okay.
And then from there, Now, not everyone qualifies at a 50%.
And you have to always consider the interest rates because that's going to have.
Well, not even just that. So you qualify for $1,500 a month, but that's your mortgage, your taxes, your home insurance, mortgage insurance, a lot of factors. So, so again, there's quick ways to do like a pre-qualifier kind of thing. But that's what the pre-approval does. It allows you to kind of get rid of the guesswork. You know exactly what you're looking at.
So what's the difference between a pre-approval, submit an offer,
fully approved,
right, and then we'll submit the offer with the pre-approval. And a lot of people, I was pre-approved, yay.
Yeah, and a pre-approval is worth as much as the paper it's written on.